Now we're going to talk about controlled groups. But before we get into how you determine a controlled group, we're going to talk about why it's important. So, if corporations are members of a controlled group, they might be subject to certain tax limitations. This comes into play, say, when you're talking about depreciation and you're talking about Section 179 depreciation. And if you think back to when you learned about this, remember there's an amount of depreciation you can take immediately, say it's $1,000,000. But it's a phase out. So if your company puts into service more than a certain dollar value of assets in that year, you start to lose that. So you start to be able to only take $800,000 of Section 179 depreciation instead of the million. So, in order to get around that, a corporation might form another corporation which they own and control and have the purchase of assets split between the two. That's just one example. There are other things they can do to kind of get around those limitations. So, in order to combat that, Congress has put into place these regulations on controlled groups. So, if two or more corporations are owned by the same shareholder or group of shareholders, they're a controlled group. And we apply this test on December 31. The corporation is included in the group if it's a member on December 31st and it's been a member of that group for at least half of the days in its tax year, which precedes December 31st. Remember, not all corporations have a December 31 tax year end. So you look back to when their tax year ends, and then you see if they were a member of the group for at least half the days of that tax year. So the first one we talk about is a parent subsidiary control group. All right, and this one, it's when there's one or more chains of corporations that are connected through stock ownership with one common parent, and then 80% stock of each except the parent is owned by the corporations in the group, and the parent owns 80% of at least one other corporation. So this is the example that's in your book. You have the parent corporation, they own 80%, the parent owns 80% of Axle. The parent also owns, by Axle and itself, 80% of Wheel Corporation. So they're all part of a group. The parent, Axle, and Wheel are all part of a consolidated parent subsidiary group because parent owns directly 80% of Axle, and then Axle and parent both together own 80% of Wheel. All right, these examples are found in the Treasury Regulation 1.1563-1. And I'm going to go through their examples as well because I think they're good to help you understand this. So in example 1 in the regulation, you have parent owning 80% of sub. That's easy. That's clearly a parent sub controlled group. In example 2, you have parent owning 80% of S sub, who also owns 80% of X. These are all part of the control group. Remember, we have parent who owns at least 80% of another corporation, and then collectively they own 80% of all the other corporations in the group. The same result would happen if you had, in the example over to the right, parent owning 80% of sub and parent also owning directly 80% of X. It doesn't matter. All right, and I got these examples switched. I misnumbered them. So let's talk about example 3, which is on the bottom right of your screen first. So in example 3, we have parent. Parent owns 80% of S and 80% of Y. Okay, so clearly we know P, S, and Y are part of a parent sub-control group. But S owns 40% of X and Y owns 40% of X. So because of the shared ownership, they each own 80% of each other directly or through another member of the group. So they are all a member of this parent sub control group, P, S, Y, and X. Now going back to example 4, we have P. P owns only 75% of Y and only 75% of Z. Those alone would not make a parent sub control group because it has to be 80%. However, you also see that Y and Z have reciprocal ownership. They each own 25% of each other. There is a provision in the Treasury regulations that says that intercompany holdings, which is what that is, they each own the same percentage of each other, intercompany holdings, they're disregarded when we're talking about parent-sub relationships. So if they're disregarded, that means that we treat P as owning 100% of Y and 100% of Z, so therefore they are members of a control group. All right, the next type of control group we're going to talk about are brother-sister control groups, and I think these are a little more difficult to understand, and I'm going to go again to the regulation language here. So first of all, there's two types of tests. There's the 50-50 test and the 50-80 test. Depending on which tax provision I'm talking about will depend on which test is going to apply. So for Section 179, for example, the 50-80 test applies. All right, so I'm going to go through each test. So first, the 50-50 test. There are two or more corporations are members of brother or sister controlled groups if 5 or fewer persons own more than 50% of total voting power of all classes of stock, or more than 50% of the total value of all shares of all classes of stock for each corporation. All right, so that's the 50-50 test. That will encompass more corporations than this next test we're going to talk about, than the 50-50 test. So under the 50-50 test, we have 5 or fewer persons owning at least 80% of the total voting power of all classes of stock of each corporation. So that's the 80% requirement. And we have the 50% requirement. Now, this next part, the 50% requirement, is identical to the 50% requirement in the 50-50 test we just talked about. So again, starting over, we have 5 or fewer people owning at least 80% of the total voting power of all classes of stock of each corporation. That's the 80% requirement. We also have to satisfy the 50% requirement. That says more than 50% of the total voting power of all classes of stock, or more than 50% of total value of shares of all classes of stock for each corporation, are held by 5 or fewer people. Okay, so that's the 50% requirement. And down here I have a note. The same 5 people must be used in the 50% test and the 80% test. So the 80% requirement and the 50% identical ownership requirement must be the same 5 people. So look at this example at the bottom. On the left side are your shareholders, A, B, C, D, and E. And on the top are your corporations, P, W, X, Y, and Z. And these numbers in here represent the ownership percentage of each. So P Corporation, for example, is owned 55% by A, 40% by B. Or excuse me, 45% by B. And so on as we go through this, right? So it all adds up, it should all add up to 100% at the bottom. So 55 plus 45 is 100. On the right side, we're looking at total identical ownership of the shareholder in all the corporations. So A owns 55% of every corporation but W. And W, A owns 51%. So the total identical ownership of each corporation is 51%. A owns at least 51% of each of those corporations. For B, it's 45%. But notice for B only owns shares in Corporation P and Corporation W, not XYZ. All right, and then going down, these other people don't have ownership in W or X or whatever. They don't have a lot of common ownership. So only A and B can be members of a group because they have ownership in the same corporations. So they have ownership in P and W. And then we need to do the 50 and the 80% test. So when I look at the total identical ownership of A and B and P and W, they have identical ownership of 50, or A has identical ownership of 51% of the group, and B has identical ownership of 45% of the group. So total, they have 96% total identical ownership. That only has to be above 50%. All right. Now at the bottom, the total column on the bottom, they have 100% ownership of P together and 100% ownership of W together. So that part has to be above 80. It is for them. It's 100. So P and W are brother-sister corporations, but not X, Y, and Z. All right, let's look at another example here. We have Adams and Bell corporations, and we have shareholders A, B, C, and D. Okay, and remember we're looking at the 50% test and the 80% test here, or we could do the 50-50 test. So looking at their identical ownership, A has identical ownership in Adams and Bell of 20%. They own at least 20% of each corporation. B owns 10% identical ownership in A and B, C 5%, D 5%. So when I add those up, 20, 10, 5, and 5, I only get 40%. I need to end up with 50% identical ownership to have a brother-sister group. So I don't get there. The 50% identical ownership test is not met. The 80% test is met. You can see we have Adams and Bell. They're owning more than 80%. Excuse me, A, B, C, and D are owning more than 80% of Adams and Bell, but I have to meet both. So these are not brother-sister control groups. All right, let's look again here at a similar but different example. So we still have Adams and Bell Corporation, and we still have shareholders A, B, C, and D. Now, however, C and D don't have ownership in both Adams and Bell. C has ownership in Adams, D has ownership in Bell. So that's going to change things a little bit. And when we look at common ownership, identical ownership, for shareholder A, they have 36% identical ownership in Adams and Bell. Shareholder B has 30%. Shareholder C has none, right? Because shareholder C has no ownership in Bell. So there's no percentage of identical ownership. Same with D. No percentage of identical ownership. So when we add up the identical ownership here, we get 66%. That is over our 50%. So Adams and Bell could still be brother-sister control groups. However, we need to look at the 80% test. If this is a tax provision where the 50-80 test applies, we're going to have a problem because we only include the shareholders who make this a brother-sister group, so only A and B. So for Adams, we only have 70% ownership here, not 80%. And for Bell, we only have 72%, not 80%. I'm getting that by adding up, for Adams, I'm adding up the percentage ownership A and B have in Adams. So that's 70%, 36 plus 34. For Bell, I'm going to add up the percentage ownership A and B have in Bell, so 42 and 30, 72. So we're going to disregard the amount C and D own because they don't own interest in both corporations. So if this is a test where 50-50, if this is a tax provision where the 50-50 test is going to apply, then these would be brothers. Adams and Bell would be brother-sister corporations. If this is a tax provision where the 50-80 rules apply, they would not be brother-sister corporations. All right, now let's look at this. So we have Tate and Ward corporations, and we have A through H shareholders. Our percentage of common ownership is 100% because Tate, A, B, C, D, E, F, G, and H own equal percentages in Tate and Ward. They're the only owners of Tate and Ward. So the 50% test applies. But we're going to have a problem when we're looking at the 80% test because it's the brother-sister corporation has to be 5 or fewer people owning 80%. Well, no 5 of these shareholders own 80% of either corporation. Now, if the 50% rule were to apply, then they could be brother-sister corporations because 5 or fewer people do own 50% of Tate and Ward. But if the 80% rule applies, then these are not brother-sister control groups because no 5 people own 80% of Tate or Ward. All right, the next control group we're going to talk about is the combined control group. And that's when we have 3 or more organizations where each is a member of a parent sub-control group or a brother-sister control group, and at least one corporation is the common parent of a parent sub and also a member of that brother-sister group. So here we have Able and Coast, and they're members of a brother-sister group through the ownership of Barbara and Art. And then we have Best Corporation, who owns 100% of Able. So that's a parent sub. Able owns 100% of Best, so that's a parent sub. Able is the parent. So Able is a member of a parent sub as the parent. Able is also a member of a brother-sister. So this is a controlled group, a combined controlled group, and Able, Best, and Coast are all members of the group. All right, so we just talked about that. We have 3 or more organizations where each is a member of a parent sub control group or a brother-sister control group, and one corporation is the parent of the parent sub and also a member of a brother-sister group. All right, now we're going to look at exercise 3-52. This is in your book. It's control groups. Which of the following groups constitute controlled groups? Any stock not listed below is held by unrelated individuals, each owning less than 1% of the outstanding stock. For brother-sister corporations, which definition applies? All right, so A, Judy owns 100% of the single class of stock of Hot and Ice Corporation. All right, so this one's pretty simple. In A, we have Judy. She owns all of Hat and all of Ice. So it's pretty clear these are related. It's 100% common ownership. It's only Judy. And she owns 100% of both corporations. So it's a brother-sister control group. It meets all the tests. It meets the 50-80 and the 50-50. Okay, B, Jones and Kane corporations each have only a single class of stock outstanding. The 2 controlling individual shareholders own the stock as follows. So we have Tom and Mary. Tom owns 60% of Jones, and Tom owns 100% of Kane. Mary owns 40% of Jones and none of Kane. All right, so that's B down here. So here we see Tom, and he owns 60% of Jones and 100% of Kane. So when we're talking about percentage of common ownership, his is 60%. He owns at least 60% of both Jones and Kane. Mary owns 40% of Jones, but none of Kane. So she has no common ownership here. She just owns no identical ownership here. She just owns shares in Jones. All right, so we have only 60% common ownership, it's over 50. So that would apply. But we also have to meet the 80% test. And we don't meet that here. Tom only owns 60% of Jones. We don't count Mary's because she's not part of the group. So we don't meet the 80 test here. So we don't meet the 50-80 test. Now, if we were using a tax provision where we just had to meet the 50-50 test, we would meet that because Tom owns 60% of Jones and 100% of Kane. So we would meet that test. We would be over 50%. And they would be brother-sister controlled groups under that test. Okay, looking at C, we have Link, Model, and Name corporations. They each have a single class of stock outstanding, and it's owned as follows. All right, it also says that Link Corporation stock is widely held by over 1,000 shareholders, none of whom own directly or indirectly more than 1% of Link's stock. Okay, so notice here we have 3 corporations and then unrelated individuals. And this one is a little tricky. I find it easier to kind of diagram it. So that's what I did over here. All right, we have Link, Model, and in is Name. So Link, Model, and Name. Link owns 80% of Model directly. Link owns 50% of Name directly, and Model owns 40% of Name directly. So this is a parent sub control group, and it's a parent sub control group because one parent corporation, L is the parent, owns 80% of one sub corporation, and also 80% of each. So 80% of L, M, and N 80% of each except the parent. So 80% of M and N is owned by the corporations in the group. All right, so M owns 40% of N and L owns 50% of N. So N is owned by members of the group, L and M. So this is a parent sub control group. All right, next we're going to go to D. And under D, we have oat, peach, rye, and seed corporations, each having a single class of stock outstanding. It's owned as follows. All right, so we have Bob, who is an individual. Oat, rye, peach, and seed corporation are all corporations. And then we have some unrelated individuals owning 10% of peach and 20% of rye and 10% of seed. Okay, since these people are all unrelated, I disregarded the percentages attributable to the unrelated individuals. All right, so we see oat and peach are brother sister. All right, let's look back at that. How do we know that? Well, oat is owned 100% by Bob, and peach is owned 90% by Bob. So they have common ownership. They meet both the 50% and the 80% test. So they are brother-sister control groups. All right, now let's see if we have any other relation. Well, we see we do because oat owns 80% of rye. So oat is the parent and rye is the sub. Rye also owns 60% of seed and oat owns 30% of seed. So we meet all of those tests. We have the parent-sub relationship, and then seed and rye are all owned by members of the group. All right, so we have a parent-sub. Oat and peach are brother-sister. Oat is the parent in a parent-sub. So putting these two together, we meet the definition of a combined controlled group because oat is the parent and the parent-sub and also a member of the brother-sister group. We would not meet it, however, if seed was the parent. Remember, the parent has to be somebody who is a member of both groups. So if seed were the parent here, we wouldn't meet it because it's only oat and peach that are brother-sister. But since oat is the parent and oat is also a member of the brother-sister controlled group, we have a combined controlled group here. And all four corporations are members of this group. So oat, rye, seed, and peach are all members of this controlled group. All right, this slide is going to tell you which the 50-50 or the 50-80 test is going to apply for various tax provisions. And you can ignore the first two line items, the low bracket tax rates and the AMT exemption. Those are left over from pre-Tax Cuts and Jobs Act. They're not applicable anymore, but they have not yet been updated. So the only ones that matter to us are the minimum accumulated earnings tax, 179, and the general business tax credit limitation. All right, so for the minimum accumulated earnings tax, we only have to do the 50% brother-sister test. We have to have the greater than or equal to 80% parent sub test. For the Section 179, the 50-80 test is going to apply. And then under parent sub, which you can ignore this parent sub, we haven't really delved in that yet. And then for the general business tax credit limitations, only the 50-80 test applies. All right, so again, why does this matter? Well, it matters because we are concerned that corporations are forming control groups to kind of circumvent some of the limits in place in the tax law. So if corporations are members of a control group, apportionment of certain tax items is required. So dividing it up. So using the Section 179 example we were talking about before, if it's a 50-50 brother-sister relationship, then Corporation A is going to get half the Section 179 depreciation amount, and the limit where phase-outs start is also going to be cut in half. And then Corporation B gets the other half, for example. It also matters because Section 267A1 is going to defer losses between members of controlled groups. Remember, Section 267 is the provision that deals with related parties. So we talked about brother-sister, family relationships, and entity relationships. These are entity relationships. So if two entities are treated as related, 267 267A is going to limit how they can do business with each other. So 267A1 is going to defer losses between members of controlled groups. So if I'm Corporation A and I'm related to Corporation B, I sell something to Corporation B and I sell it at a loss. I can't recognize that loss right now. I'm going to defer it to later. Because remember, for tax purposes, we like losses because we don't like paying as much tax. 267A2 is going to prevent recognizing expenses of an accrual method corporation until the controlled group member cash basis corporation has recognized income. So if I am an accrual basis taxpayer and I have an expense that I have accrued but not yet paid, normally I would get to take a tax deduction for that. But I can't do it if I'm a member of a control group and I owe that expense to another member of the control group, and that other member of the control group is a cash basis taxpayer. Because what can happen? Well, I can take the deduction before I pay the expense as the accrual basis taxpayer, but the person I owe the expense to will not recognize income until they receive the money. All right, so without this provision, we could get together, Corporation A and Corporation B, who are members of a controlled group, and we could just say all these fictitious transactions occurred and I owe the money, but I will never pay the money. So what will happen is Corporation A will get a tax deduction because they have accrued the expense, and Corporation B will never ever report that money in income and therefore pay the tax on it because they're a cash basis, so they never received it. All right, some other things about controlled groups. Most parent sub-controlled groups are eligible to file consolidated returns. Consolidated returns are dealt with more in detail in Chapter 8, so we're not going to talk about them quite a bit, but we're just going to hit the high points. So we would elect that if for brother-sister corporations, if our members agree to do it, and an election would be made by combining all the income and expenses of each member on a Form 1120. And like I said, each corporate member must agree to the election. For brother-sister corporations, the broader 50% only definition applies for limiting the reduced tax rates. Some advantages of this would be losses of one member of the group can offset profits of another. So if I have losses that normally would just be a net operating loss, and I'm a corporation who runs losses a lot, I may not get the benefit of that. So if I combine my tax return with another member of the group who made a ton this year, we could kind of offset each other. Capital losses of one group member can offset capital gains of another, because remember, for corporations, I can't deduct capital losses at all unless I have capital gains. And then profits or gains realized on intercompany transactions are deferred until a sale outside the group occurs. So if I have organized this group of corporations for business purposes, say A manufactures something and sells it to B, which manufactures something and sells it to C, and then C puts it all together and sells a product to customers. So say we have a chain of corporations set up that way. Normally, I would recognize profit on every one of those sales, absent a consolidated return. If I have a consolidated return, I can defer all of that profit or gain until the sale outside the group, until I sell my product to customers. There are disadvantages too. The election's binding on all subsequent years unless the IRS allows me to change the way I'm filing returns. So you really need to think that through when you decide to file consolidated returns. Losses on intercompany transactions are deferred until a sale outside the group takes place. So this is the flip side of what we just talked about on the last slide, right? Profits are deferred until a sale outside the group takes place, which that's good. We like to defer paying taxes, but losses are also deferred. So again, we like losses for tax purposes, so I am not allowed to take them. One member's Section 1231 loss offsets another member's 1231 gain instead of being reported as an ordinary loss. Losses of an unprofitable member of the group may reduce the deduction or credit limitations of the group below what would be available had the members filed separate tax returns, and the group may incur additional administrative costs in maintaining the records needed to file a consolidated return.